Hello viewers, welcome back to our YouTube channel, KC Accountancy Education Center, and today we want to look at estimating of the growth in dividends, and we incorporate it in our computations using the Gordon model. So want to estimate estimating the growth in dividend. Now, this is a little bit tricky. It's a tricky part of all the things that we do as far as Gordon model is concerned. The examiner might not give you the growth rate, but he has given you additional information. So he may not give you the growth rate, but he gives you some additional information that you can use to be able to compute the growth rate or the growth in dividend. And sometimes what they do, the examiner can, for example, give you the years and their corresponding dividends paid, where these dividends will be increasing, and in this case you cannot conclude that there is no growth rate since the dividends are not constant, because they may give you these dividends, but the dividends are constant. Every year their pay may be same amount, or they may give you the dividends, but these dividends are keep on increasing, meaning there has been some kind of increment. So what do we do if at all we have such kind of scenario? So if we have such kind of scenario, we have two methods that we use, and we are going to look at both of them to be able to conclusively have everything in what we want to cover. So if the dividends are not constant in nature, then you are expected to compute the growth in dividends. We also discussed this in paper 10, but we are trying to repeat it so that we can be able to be on the same page, because it will be very sad for you to actually fail things that you already know. So the two methods we have, there are two methods that we can use to compute the growth when the dividends are not constant. One, we can use the formula G equal to, we have the latest dividend over the earliest dividend. So all of this minus 1. So in here we have n minus 1, where n is actually the number of years. So let's have a small simulation that will help us to have a table that will help us to understand. Let's look at a simulation. So we can have this, can say the dividends of KC group over the last 5 years are given below. So we can have the years, then we have the dividends. Year 1, it's 180. This is 210. This is 220. This is 24500, and then the last one is 28. 280,000. This is 5th year, 4th year, 3rd year, 2nd year. So that's the information that we have, and they are telling us that KC group is current ex-div market price is UJEX 4,000, and it has in issue 1 million ordinary shares. Full stop. We have the required. They are telling us to calculate the company's cost of equity. So we need to get the company's cost of equity. Solution. Let's now look at the number of years, N. Our N, they have given us 5 years. And what is N minus 1? Because we saw it supposed to be in the formula. So this is going to give us 4. This will be 4 years. Now we need also to know what is the latest dividend. The latest dividend is 280. Then the earliest dividend is 180. So we substitute in our formula. We've said that G, the latest, which is 28, divided by 180. Of course, all of this is supposed to be under square root minus 1. But this one has N minus 1, which is the 4. So the 4th root of these two items. So this, you will see that this is going to give you 0.12, of course, times 100. And that is going to give you 12% as the growth rate. That is the growth rate. That's how we compute the growth rate. The whole idea is actually for us to be able to compute the growth rate, because the rest, substituting in the other method, is going to be very easy for us. So that is the first method. Then the second method, of course, the second method is what we call the Gordon's growth model. Gordon's growth. The other one is Gordon model, but this is Gordon growth model, or what we call the Gordon's approximation, growth approximation. Gordon's growth approximation. So it is the same person who introduced in this. So is saying G equal to R times B, where R is our return on capital, or what we call the cost of capital. The return on invested capital, or return on capital. This is the cost of capital, or RRR, the required rate of return. Then B is now the retention rate. Retention rate. Now the retention rate is actually, it means the remaining, or what we have retained, the remaining rate after deducting taxes, after deducting the rate of dividend, after deducting the rate of dividend. If let's say, for example, if we have paid maybe, we are saying that maybe we can pay 40% of our profit after tax, then what has been retained is the 60%. So it will be 100 minus the 40%, which will give you the 60%. That is the retained that we are talking about. So you get the retained profit after tax, then you multiply by the required rate of return. That will give you the growth in dividend. So for this formula, the examiner will be talking about the retention rate. For example, if let's say, if you are the CEO of the business, as I said, you decide that maybe you are going to pay dividend of, let's say, 50%, 60%, and you are going to pay dividend of, let's say, 60%. So the retention will actually be the remaining part that you have not declared as dividend. So it will be the 100 minus the 60 you have declared. So the balance is going to be the 40%, which is the retained amount. So what you have to understand is that in this question, he will tell you what the rate of return is, the rate of capital or the cost of capital for the monies that you have reinvested in the business. It's the one that we call the required rate of return or the cost of capital, whichever name they call it. However, these numbers are not set as a standalone numbers. I don't want you to assume that a number is going to be set as a standalone. No. But they will bring one question that requires you to compute the cost of capital, the cost of equity. They want you to compute the cost of capital because in some of the capital structure, they have given you equity. But when you look at the equity components, the information they gave it for you to compute the specific cost of equity is actually lacking the growth in dividend. That's why you look for the information that has been given. You choose any of these two information or these two methods that you can use. So don't get confused. This is just a small issue within the cost of capital. So we are done now with the Gordon model. But you have to watch out this aspect. One, we said you have to watch out to see whether they have given you the growth rate. Two, you have to find out, have they given you a current dividend or a future dividend? If you can have this with you, then you will be able to do any number that will require you to use Gordon model for computing what we call the cost of equity. So we are done with the cost of equity. And what I want us to do is to go ahead and look at what we call the cost of term loans. This is something that is very, very easy. The cost of term loan. So that's what we are going to look at in the next video.